Gold prices have been hitting record highs, fueled by economic uncertainty and central banks stocking up on the metal like never before. But what if I told you that a single government decision could change everything, instantly wiping out gold's momentum and shaking up the financial system? Right now, the US is sitting on over 8,100 tons of gold, the largest reserve of any country. But there's a catch. The government values its gold at just $42 per ounce, a price set over 50 years ago. If the US were to update this valuation to reflect today's market price, around $3,100 per ounce, it could suddenly add hundreds of billions of dollars to its balance sheet. This is what's known as a gold revaluation, a move that could shake the global gold market, disrupt prices, and change how investors see this commodity. A gold revaluation happens when a government increases the official price of its gold reserves without actually changing the amount of gold it holds. It's like suddenly realizing that an old painting you own isn't worth $1,000. It's worth $1 million without ever touching the artwork itself. For the US, this means that instead of valuing its 8,100 tons of gold at just $11 billion, it would be worth closer to $800 billion at current prices. But here's the crucial part. This isn't just an accounting trick. Once the US government officially recognizes this higher gold value, it can monetize it, meaning it can turn this paper wealth into actual spending power. How? By issuing gold certificates to the Federal Reserve in exchange for bank deposits. These deposits can then be used to fund government spending, reduce debt, or even create a sovereign wealth fund. On the surface, this sounds like a financial cheat code, a way to inject money into the system without raising taxes or printing new dollars. But it doesn't go without consequences. If the US revalues its gold, here's how it could disrupt the market. If the government monetizes its gold, it could eventually start selling portions of its reserves. That would mean more gold flooding the market, which could lead to a price drop, and with the US being the largest holder by far, the drop would be significant. For decades, gold has been the ultimate hedge, a way to protect against reckless government spending and inflation. But if the US suddenly embraces gold as a financial tool, it could change how investors see gold's role in the financial system. If the US Treasury monetizes its revalued gold, it would effectively be injecting new money into the economy, potentially fueling inflation. The Federal Reserve might step in to counteract this by selling government bonds, tightening the money supply, and pushing interest rates higher. If that happens, gold could lose its appeal compared to high-yield assets like bonds and cash deposits. So why would the US even consider a gold revaluation? The answer is simple: debt. Right now, the US national debt stands at a staggering $36 trillion, and it's growing fast. Treasury Secretary Scott Bessent recently hinted at monetizing assets on the government's balance sheet, which some analysts believe could include gold. If the US were to revalue gold and monetize part of it, it could theoretically reduce the national debt without printing more money, fund government programs without issuing new bonds, and stabilize financial markets during a crisis. But here's the catch. This isn't a magic fix. Even a $789 billion increase in gold reserves wouldn't make a huge dent in the $36 trillion debt. And on the other side, revaluing gold could signal to investors that the US government is in deeper financial trouble than it publicly admits. By suddenly increasing the official value of its gold reserves, the government would essentially be acknowledging that traditional fiscal and monetary tools, such as taxation, spending cuts, and bond issuance, are no longer enough to manage the national debt. This could create a perception of desperation, similar to how struggling economies resort to unconventional measures when their financial stability is at risk. Such a move hasn't been done in decades, with the last revaluation occurring in 1973 when the gold price was adjusted from $38 to $42.22 per ounce. If the US revisits this strategy now, it might raise concerns among global investors about the country's long-term economic outlook. This could weaken trust in the US dollar, trigger capital outflows, and push investors toward alternative safe haven assets like foreign currencies, cryptocurrencies, or even gold itself. While some might argue that a gold revaluation could help stabilize government finances, others would see it as an admission that the US is struggling to manage its debt, potentially leading to higher borrowing costs and market instability. If such a policy were to be pursued, it would likely happen under an administration willing to take bold, unconventional economic measures, such as a second Trump presidency. However, even then, the risks of shaking investor confidence in U.S. economic leadership would remain high. So will the U.S. revalue gold? Right now, the official stance is uncertain. While some policymakers have floated the idea, others have dismissed it, saying it's too risky and wouldn't provide enough financial relief to be worth it. The last time the US revalued gold was following the collapse of the Bretton Woods system. Since then, the official valuation has remained unchanged, even as market prices have soared. But the fact that this conversation is happening at all tells us something important. Gold is becoming more relevant in global finance than it has been in decades. Whether or not the US moves forward with a gold revaluation, investors need to be prepared. If gold's role in the financial system changes, whether through government intervention or shifting central bank policies, it could lead to a major repricing event in the market. So, what does this all mean for investors? Pay attention to government policy. If discussions about gold revaluation gain traction, it could signal a turning point for the market. Be prepared for volatility. If the US starts managing gold more actively, expect price swings as markets adjust to the new reality. Don't assume gold is untouchable. Many investors see gold as the ultimate safe haven, but if the government starts using it as a financial tool, that could change. At the end of the day, the biggest risk to gold prices might not be inflation, interest rates, or even central banks. It might be the US government itself. What do you think? Would a gold revaluation be bullish or bearish for the gold market? Let us know in the comments. And if you want to stay ahead of the biggest financial trends, don't forget to like and subscribe. Thanks for watching.